Do you remember when you were young and you used to roll a small snowball down a hill? By the time that it got to the bottom of the hill, this snowball, which started out small, had grown into a huge one. Depending on how long the hill was, your snowball would gather more snow and get bigger and bigger. The longer the hill, the bigger your snowball would get. The idea of snowball investing is similar to rolling a snowball down a hill. If you invest in dividend growth stocks for a long time and reinvest the dividends you get, your dividends will grow into a huge amount in a relatively short amount of time. A dividend snowball is a cycle in which dividend income keeps going up. This capital is made by buying shares in dividend growth stocks. As you hold on to these shares, the dividend income you get from them grows. Fresh capital, the practice of reinvesting dividends, and dividends that grow on their own, all help to increase dividend earnings. Similar to the snowball effect is the idea of compounding. It shows how actions that don't seem important at the time can have big effects over time. How does the dividend snowball work in the real world? Dividend reinvestment plans run by a company. Only a small number of dividend-paying blue-chip companies run their dividend reinvestment plans. Coca-Cola and Johnson & Johnson, for example, both have their own direct stock purchase plans that reinvest the dividends from the stocks. Dividend reinvestment plans from outsiders. Firms that pay dividends sometimes give dividend reinvestment plans to third parties or transfer agents. Please be aware that these agents usually charge investors a fee for their services. Brokerage dividend reinvestment plans. Investing in dividend reinvestment plans is also easy to do through the vast majority of brokerages and robo-advisors. At your brokerage, you will need to choose dividend stocks to put into the dividend reinvestment plan. Then, every time you get a dividend payment, your brokerage will put it back into more shares of the company. Using a snowball strategy to invest in dividends can be done in this way, which may be the simplest way to do it. Self-implemented dividend reinvestment plans. If the dividend company you choose doesn't have a dividend reinvestment plan, and neither a broker nor a third party makes it easy to reinvest dividends, you can handle the program yourself. This is called the self-implemented dividend reinvestment plan. You just need to reinvest your dividends to buy full or partial shares for the same amount as the dividend. Compounding and dollar cost averaging are two ways to get the most out of a process that would be harder to do on its own. Steps for dividend reinvestment. Make sure to choose dividend growth stocks that have a history of increasing their payouts every year. But you should make sure that the payout ratio never goes above 75%. If the company's payout rate is on the lower end, this means there's a better chance that dividends will go up in the future. To win at the dividend snowball game, you need to be consistent. If you get enough dividends, you should make a contribution every month so you can buy things. Dollar cost averaging is what happens when you buy dividend-paying stocks every month. This helps reduce the short-term volatility of the stock market as a whole. This is one of the best ways to make a steady income over a long period of time. You can speed up how much your dividends grow if you use the money you get from them to buy more shares of the company. Also, when dividends are reinvested, no commission is charged. This makes this strategy a win-win for long-term investors. The dividend snowball method involves making regular investments over a period of time, usually between 5 and 20 years. So, having time and being calm are the keys to success in this situation. The good things about using the dividend snowball method. The dividend snowball method is one of the best ways to make a steady passive income over time for two main reasons. Here are some of those reasons. Dollar cost averaging is a feature of dividend reinvestment plans that lets you slowly buy more shares without having to pay any extra commission fees. Through their dividend reinvestment plans, a number of different companies give shareholders the chance to buy at a discount of between 1 and 10% below the current share price. The cost basis for owning the new shares is much lower than if they were bought on the open market. This is because there are discounts and no commissions. Through a program called Dividend Reinvestment Plans, investors can buy fractional shares, which makes every dividend dollar useful. Compounding returns are the biggest and most important reason to invest in dividend growth companies. They are also the best reason to invest in dividend growth. When dividends go up, shareholders get more money for each share they already own. This gives them the chance to buy even more shares. This in turn makes it more likely that the investment will pay off completely as time goes on. Because the price of the stock has gone down, more shares can now be bought, which makes it more likely that there will be bigger gains in the long run. How to use the dividend snowball strategy with your individual retirement account. Most investors want to have a comfortable retirement with a large nest egg, so they work their whole lives to build up their asset base. One of the best ways to make more money in retirement is to invest in stocks that pay dividends and use a strategy called the dividend snowball. Along with the money you get from Social Security and your pension, dividend payments can also be a source of income in the long run. When investors put in a little bit of work, they may be able to make a lot of money through dividend income. People who want to save more for retirement could use the method of reinvesting dividends to buy more stock. If they keep going in this way, they will eventually get bigger and more important dividends. The dividend reinvestment method, also called the dividend snowball strategy, is a way to invest over a very long period of time. Investors often have to keep reinvesting their dividends after they retire because most dividends aren't enough to cover their immediate needs. The dividend payments won't make a big difference in a retired person's annual income in any meaningful way. If, on the other hand, an investor keeps reinvesting the dividends they get each year, they will be able to grow their portfolio without giving up any new sources of income. The dividend snowball method is one of the easiest and most cost-effective ways to slowly build up a person's retirement savings over time. Traditional dividend growth stocks like Procter & Gamble and Coca-Cola are some of the safest investments for retirees. Most of the time, the dividend rates on these stocks go up, which helps them give returns in the future that are higher than inflation. When investors put these kinds of companies in their retirement portfolios, they give up the dividend return they are getting now in exchange for a bigger payment in the future. Most ways to save for retirement require that account holders start taking money out of their accounts at a certain age. So when people reach retirement age, they can take money out of these accounts and use it to keep their standard of living the same. This gives them the freedom they need to decide where to put their dividends. The dividend snowball strategy has a lot of potential, but it may not be right for every situation. At the beginning of retirement, this might be the best way to go. But if a retiree's medical bills go up, or if he spends down his savings, it's possible that the investment will become less beneficial over time. How the dividend snowball affects things and how taxes work. Before an investor can use the dividend snowball method, they need to know how it will affect their taxes. Because a dividend is considered taxable income, the Internal Revenue Service will still count it as income even if you invest it before it goes into your account. On Form 1099 DIV, dividend income could be marked as either qualified or non-qualified. It's important to know that dividends from master limited partnerships, employee stock options, and real estate investment trusts do not count as qualifying dividends. Also, dividends from funds and companies based in the United States are considered qualifying dividends. Dividends that aren't qualified are taxed at the same rate as regular income. However, qualified dividends may be eligible for a better tax treatment than long-term capital gains. What did you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.